First of all, the Buffett indicator to me is more of a bullish thing than a bearish thing. The government floods everyone with money so that they can YOLO again. I don't see this happening. The small businesses are having trouble competing with large businesses. You're worried about AI, you're worried about all these factors. You do have a political bias because of the polarization. Because stocks have fallen 20%, then either the central bank and or the government has to come in because they can't allow it to fall down. The Johnson Red Book most recent reading is up about 9% year over year. It's accelerated during gas prices going higher. One of the big mistakes that people make is the savings rate should decline when people are feeling optimistic about their jobs, the stock market, whatever the case.
In this conversation, macro strategist and portfolio manager Jordi Visser makes a case that most bearish analysts are missing, not because the risks are not real, but because they are misidentifying what is actually driving markets. His argument is that we are living through a generational global bull market whose engine is artificial intelligence, and that engine is still in its very early innings. The Buffett indicator, in his reading, is not a warning sign. It is a reflection of a structural transformation in how corporate earnings are generated, and why profit margins in the technology sector have been expanding for 17 consecutive years.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
The reality is profit margins are growing and earnings are growing. Until that changes, which, the breadth of profit margins is not good. It is isolated to mainly tech companies, but that's been the case now for 17 years. So there's two ways to look at this. First of all, the Buffett indicator to me is more of a bullish thing than a bearish thing. Every time I hear people say this, and I reflect on it all the time, we talked about it during Liberation Day last year. The reason it was a positive is because every time someone on the macro side calls me up all bearish when we start bombing Iran, when Iran starts shutting down the Strait, when Liberation Day happens and we're worried about tariffs, and we all come back to the same reason, which is exactly where we are now versus last year, it is a form of taco. I mean, I hate to say it, but there's no way that Trump can continue, and we've seen no real bombing. Every time the U.S. bombs, what do they say? Truce is still on. This is just, minor skirmishes. And the reality is we're a financialized economy. And if we want to help, which we do through transfer payments, it's a major voting block. We can't allow people to lose their jobs. We can't allow gas to go up to $10 a gallon if we have control over it. And I think Trump has figured a way to say, okay, if I keep bombing, then it's going to take longer. And I've run out of time. We've used all the buffers. There's no question about it. Inventories are being drained. Strategic petroleum reserve is being drained. So I think people just have to realize that the Buffett indicator is a representation of what you said, earnings and profit margins, which are growing exponentially. Small businesses are having trouble competing with large businesses. Most of the companies in the S&P 500 that are working are technology companies. Now you've got derivative technology companies, which are related to the infrastructure. Soon you're going to have healthcare companies and pharma companies and things like that that are benefiting from longevity with AI. All of these things are just going to continue. And what you're doing is you're going to continue to have this situation where the Buffett indicator, when it starts to fall, because stocks have fallen 20%, then either the central bank and or the government has to come in because they can't allow it to fall down.
Now, the MSCI World Index ex-US is also at an all-time high, which suggests that this is not just a domestically driven, bull market. This is kind of a global, almost generational bull market that we're living through. What do you think is driving these other countries or other markets outside the US?
It's the same thing in the US. We import a lot of things for artificial intelligence. The data center build out, the optical side, obviously memory. Inside my artificial intelligence thematic portfolio, I think there's 15 to 20 names that are international. Semiconductor companies like ASML and Soitec, and chemical companies like Ajinomoto out of Japan. All the Japanese ones, all of the Korean ones, the memory names, they're the major winners. But also countries like Germany build a lot of things like Siemens Energy and stuff. So when you have a manufacturing need, which is what we have when PMIs are up, it usually brings in other countries. The big thing for me is most of the other countries of the world suffer from what's happening with energy. They don't have the same situation as the US. They don't have unlimited natural gas. They don't have the situation of being the largest exporter of energy. So with that situation, when I see global markets still doing well, when Korea and Japan are doing exceptionally well, and these are countries that depend on importing chemicals and oil, that is usually a very strong sign that this is not just an isolated thing in the US, but you have to think about the AI trade being a much bigger thing. And I'll just add one more thing for people who don't realize this. Johnson Redbook is a weekly release that shows consumer spending. So it's kind of like retail sales, but it comes out every week. The Johnson Redbook most recent reading is up about 9% year over year. It's accelerated during gas prices going higher. So you can't get past the fact that the PMIs are still trending higher and strong. Transportation and flatbed rates are high ex oil, which means the shipping part of the economy is strong, which is confirmation on the first. Earnings revisions don't stop. They've continued to move higher, and global markets are seeing strength. So when you put all that together, to be worried about something that is already old news, meaning, I hate to say it, but oil doomers, it's old news. It doesn't mean we won't have inflation stay above 4%. It doesn't mean that we won't see problems in the second half of the year. But I think people that have been too fixated on when the floor is going to drop out are missing the point that the AI generational situation is still in the first or second inning.
The Buffett indicator is high because earnings and profit margins are genuinely high, and they are growing. The concentration of those earnings in technology companies is real, and has been real for nearly 2 decades. But rather than treat that concentration as a vulnerability, Visser treats it as a structural feature of a new kind of economy, one where scalable, asset-light technology businesses generate returns on capital that are simply incomparable to the industrial companies that dominated the index in prior generations.
One of the big mistakes that people make is the savings rate should decline when people are feeling optimistic about their jobs, the stock market, whatever the case is. So,
Oh, you mean they're deploying their capital?
Or they're spending money out of the stock market, whatever the case is. They have huge savings that are being built up in the stock market. I know that people talk about the fact that most people don't have money in the stock market. The reality is pension funds represent a good portion of people in the country. They have money in the stock market. So when the stock market's going higher, the economy and people's ability to spend money is still there. So this whole thing fits in. The more you read X, and this is one of the reasons why I think, you gave a stat from the University of Michigan, which differs from what's happening at the headline consumer confidence level. And everyone tries to write it off as, this is just politics, this is just this. I don't think it is. I do think it's 2 factors. One is, there's no doubt that when you spend a lot of money and your wages are not growing at a fast pace, your house is not going up in value and you're kind of trapped in it, which is the reality for most people in the country. You're worried about AI, you're worried about all these factors. You do have a political bias because of the polarization. But then you also have the doomers in X, and you have all the news, which is geared towards scaring people. I think at the end of the day, it's more of a fear factor that is also representation of the amount of information that we're getting as an overload, and all of these negative things which just continue to be brought out. And one of the factors that I think is becoming more of an issue, I think countries of the world, particularly China, does not want the US to have an optimism on AI. They want data centers to be stopped. It is a race towards getting global power of AI and actually being able to deploy it across the globe. And I think slowing it down here, making it more of a political thing, which seems to be working, at least reflected in consumer confidence, is just the nature of where we are. The distribution of wealth problem is real. In the same way, like if you take the Andover situation for a data center, and you say, okay, that's one side, and that's residents of the country. But then you go to a college having Eric Schmidt speak at it, where he gets booed. I mean, Eric Schmidt created a tool forever, was part of a company that
probably helped a lot of those graduates get to the finish line.
Yeah, and again, because of what Google's been able to do, they bought DeepMind. They're going to help people live forever, all of these different things. But imagine Steve Jobs being booed for the iPhone. But we're at that stage now where the distribution of wealth problem has caused such a huge problem that whether it's residents in a country caring about, or in a county or a city caring about their kids, or it's students, 20-ish years old that are booing one of the fathers of the greatest thing that they've ever been able to have. That just shows kind of this Schumpeterian thing of heading towards socialism, heading towards this distribution of wealth problem. And I don't see it getting better based on artificial intelligence. So I think if people are looking for, when is this going to get better? When is consumer confidence going to go higher? Well, unless we have some kind of hiring boom, or unless we go into another pandemic, the government floods everyone with money so that they can YOLO again. I don't see this happening. So I think this is this permanent trend. So when you see these charts and you're like, okay, this has to snap back. This has never happened. It's not a bearish chart. It's just a representation of the distribution of wealth problem that's happening around the globe. And it will remain something that the governments, number one, have to print. Number two, that Buffett indicator fits right in with it. He can't let the Buffett indicator go down. You have two choices. I have to keep this thing afloat and make sure I'm supporting this financialization of the economy, or I have to allow a Great Depression to reset everything. And that's not an option. So you're left with the first one, which is just make sure that, as this administration said a year ago and people didn't listen to it, okay, we've made the decision. We started the tariff thing. Now we're going to run it hot. We're audibling. We're going to run this hot. They've been running it hot. They're going to continue to run it hot.
Yeah. What do you think are the downsides for the wealthy people when they run it hot? Are there any? Like, we know what the downsides are for the bottom of the K-shape, right? But are there downsides to the folks who have high income, have assets, et cetera, when they run it hot?
Again, when you say downsides, it's really hard to say how a wealthy person suffers if asset prices are going higher. They continue to go. I could say that it'll be a different story 3 years from now or 4 years from now. I could go through some of my futuristic things on abundance and how abundance is not good for people that own scarce assets, because wealth turns into scarcity. You take your money and you put it into assets that are scarce. And that means you're trying to find a way to go. If I believe in abundance, and I believe that all art will have a completely replicated thing where you don't know what's real or not, I could say that does it. I could say that the blockchain starts to become the bigger asset, and that the wealthy people will never accept the blockchain and will never kind of go into it. I could come up with all these different ways, but I've joked about this before. I think the ego that's associated and what people have as they've made money, and having worked on Wall Street for a long time, I think the greatest risk to people that have made a lot of money is that it gets hard to make money in the future. It's hard to have a job. People do look upon how their kids are doing. You see it at baseball games, yelling at their kids or doing this and that because they're not living up to what they said. I just think the economy is going to go through a very different stance where the way we view money and the distribution of wealth, I do think there's going to be a normalization because of education, because of commoditizing the ability of intelligence. On a side note, and this is something that I think is important, I've had the luxury with being connected to you to go to a lot of your events, and at those events and at the dinners afterwards, I meet a lot of people, and these people are grateful for having people like you and me talk to them at a level that kind of makes them feel like they have a chance, or at least give them the chance to have a little bit of that feeling, maybe not of being in the top 1%, but of making some money trading, of being involved in things, maybe getting invested in things, maybe learning how to use AI. So this week, I made the decision, because the question I've been asked the most as a crowdsourcing person is, how do I start with AI? So for the first year, it was, how do I use it? What do I do? Can you give me a tutorial? So I did a tutorial, did a video series. And I realized in going through it that most people kind of did that, but they didn't do anything else. And I realized that showing people how to use it, especially with chat and things like that, was not enough. So I did a video that it's released on YouTube, and it is titled, How Do I Start with AI? And it is meant to show people how easy it is, and they can do the journey that I did, and it will take them literally a weekend to get to the point, in my opinion, where they know enough about the computer, they know enough about the difference between chat, co-work, and code. So action, using them to do things, building things, but then finally at the end, setting up OpenClaw, setting up Hermes agents. And I think once you do that, the greatest power you can get as someone who maybe doesn't feel like they're participating in the economy, if you do that with AI, I think you're underestimating the impact that it'll have on your life and your kid's life.
Jordi Visser's analysis is challenging precisely because it refuses to be either a bull or a bear in the conventional sense. He does not tell you the market is cheap. He does not tell you the economy is healthy for everyone. What he tells you is something harder to sit with. The system is structurally rigged to keep asset prices elevated. That AI represents a genuine generational transformation that has years to run, and that the distributional consequences of all of this will continue to widen the gap between those who own assets and those who do not, with no obvious political mechanism to reverse it.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.